In the world of financial markets, understanding trends is fundamental to successful investing. A market trend represents the general direction in which a market is moving over a specific period of time. Understanding market trends is crucial for investors and businesses for several key reasons. Trends help identify market direction, optimize entry and exit points, reduce investment risk, and form the foundation for effective trading strategies. There are three primary types of market trends that every investor should understand. Bullish or upward trends show higher highs and higher lows, indicating positive market sentiment and strength. Bearish or downward trends exhibit lower highs and lower lows, suggesting negative sentiment and market weakness. Sideways or consolidation trends occur when prices fluctuate within a range, indicating an equilibrium between buyers and sellers. By identifying patterns in these trends, investors can make more informed decisions about their investments. Trends help predict potential future price movements, determine optimal entry and exit points, set appropriate stop-loss levels, and align strategies with prevailing market conditions. The market demonstrates three primary types of trends, each occurring over different time frames. Primary trends represent the long-term direction of the market, typically lasting 1 year or more. These trends show the overall market sentiment and direction. A primary bullish trend shows a persistent upward movement over time, with higher highs and higher lows. Primary bearish trends show the opposite pattern with lower highs and lower lows. Primary trends reflect fundamental economic factors and market sentiment shifts over extended periods. Secondary trends are intermediate movements occurring within primary trends. They last several weeks to months and typically move in the opposite direction of the primary trend. These corrections often retrace about 1/3 to 2/3 of the primary trend's movement. In a bull market, secondary trends are temporary pullbacks. In bear markets, they're relief rallies. Minor trends are short-term movements lasting only days to weeks. They represent temporary fluctuations within secondary trends. These are the most rapid and volatile of all trend types. Day traders and short-term speculators focus heavily on minor trends, while long-term investors typically ignore this noise. When we view all three trend types together, we can see how they relate to one another. Primary trends contain secondary trends, which in turn contain minor trends. This hierarchical structure helps traders and investors identify which time frame they're operating in and understand how shorter-term movements fit into the bigger picture. Understanding which trend you're trading within is crucial for aligning your strategy with the proper time frame. Successful traders identify the dominant trend for their time frame while remaining aware of trends in higher and lower time frames. Technical analysis is the study of market action through price charts to forecast future price trends. Technical analysts study price charts and other market data to identify patterns and predict future market movements. One of the fundamental concepts in technical analysis is support and resistance levels. Support is a price level where buying interest is strong enough to overcome selling pressure. Resistance is a price level where selling pressure overcomes buying interest. Trading volume is another critical component. Volume represents the number of shares traded during a given time period and can confirm the strength of price movements. Momentum indicators like the Relative Strength Index, or RSI, help identify overbought or oversold conditions in the market. Technical analysis is based on three key assumptions that form the foundation of this approach. The first assumption is that market action discounts everything. This means all known information is already reflected in price movements. The second assumption is that prices move in trends. Once a trend is established, it is more likely to continue than to reverse. The third assumption is that history tends to repeat itself. Market patterns recur due to consistent investor psychology and behavior. Using these fundamental principles, technical analysts identify patterns in market data to make informed trading decisions. Chart patterns are key components of technical analysis. They can be classified into two main categories: continuation patterns and reversal patterns. Continuation patterns suggest the current trend will continue after a period of consolidation. Reversal patterns indicate the current trend may reverse direction. Let's first explore continuation patterns, which include flags, pennants, and triangles. The flag pattern forms after a sharp price move, followed by a short consolidation period where price moves in a channel against the trend. The pattern completes when price breaks out of the flag in the original direction. The pennant pattern is similar to a flag, but forms a triangular consolidation rather than a parallel channel. It also signals a continuation of the prior trend. Triangle patterns are continuation patterns that form during consolidation periods. They include symmetrical, ascending, and descending triangles, each with different predictive implications. Now let's examine reversal patterns, which signal potential trend changes. The head and shoulders pattern is a reliable reversal pattern that forms at market tops. It consists of three peaks, with the middle peak or head being the highest. The pattern is confirmed when price breaks below the neckline, which connects the troughs. Double top and double bottom patterns occur when price tests the same level twice before reversing. The double top is a bearish pattern that forms at resistance, while the double bottom is a bullish pattern that forms at support. Rounding patterns represent gradual shifts in trend direction. The rounding top shows a slow transition from an uptrend to a downtrend, while the rounding bottom, sometimes called a cup pattern, shows a transition from a downtrend to an uptrend. To summarize, continuation patterns suggest the current trend will resume after a consolidation period, while reversal patterns indicate a potential change in trend direction. Always remember to confirm chart patterns with volume analysis and other technical indicators before making trading decisions. Candlestick charts originated in 18th century Japan, developed by rice trader Munehisa Hama to track price movements in rice markets. Unlike traditional line charts that only show closing prices, candlestick charts reveal 4 key price points for each time period. A candlestick shows 4 crucial price points: the open, high, low, and close for a specific time period. In a bullish candle, shown in green, the closing price is higher than the opening price, indicating buying pressure. Conversely, a bearish candle, shown in red, has a closing price lower than the opening price, indicating selling pressure. Now let's examine some key candlestick patterns that traders use to identify potential market reversals or continuations. A doji forms when the opening and closing prices are virtually the same. It signals market indecision and potential reversal, especially at market extremes. The hammer has a small body at the top with a long lower wick, showing that sellers pushed prices down, but buyers regained control. It's a powerful bullish reversal signal at market bottoms. A bullish engulfing pattern occurs when a larger bullish candle completely engulfs the previous bearish candle. This shows buyers have overwhelmed sellers and suggests a potential reversal. The morning star is a 3-candle pattern that signals a strong bullish reversal. After a bearish candle, a small indecision candle forms, followed by a strong bullish candle that confirms the reversal. Candlestick patterns are most effective when they appear at key support or resistance levels. For example, this hammer pattern appearing at a support level provided a strong buy signal, resulting in a significant price reversal. Moving averages are essential tools in technical analysis, helping traders identify trends by smoothing out price data. Price action can be volatile and noisy, making it difficult to identify the underlying trend direction. A simple moving average, or SMA, reduces this noise by averaging price values over a specific period. This 20-period SMA calculates the mean of the last 20 price points. There are several types of moving averages. The simple moving average gives equal weight to all price points. The exponential moving average places more emphasis on recent prices, making it more responsive to new information. Notice how the exponential moving average responds more quickly to price changes, while the simple moving average provides a smoother line that reduces false signals. Moving average crossovers are popular trading signals. When a faster moving average crosses above a slower one, it may indicate a bullish trend change. 2 important crossover patterns are the golden cross and the death cross. A golden cross occurs when a shorter-term moving average crosses above a longer-term moving average, signaling a potential bullish trend. Conversely, a death cross happens when a shorter-term moving average crosses below a longer-term moving average, potentially indicating a bearish trend reversal. Moving averages also function as dynamic support and resistance levels. During uptrends, price often pulls back to a moving average before continuing higher. To summarize, moving averages are versatile tools for trend identification. Different types of moving averages suit different trading styles. Shorter periods are more responsive but noisy, while longer periods provide smoother but lagging signals. Always confirm moving average signals with other indicators for better results. Oscillators are technical indicators that fluctuate between defined ranges, helping traders identify potential turning points in the market. These tools serve multiple purposes in technical analysis, identifying overbought and oversold conditions, measuring market momentum, signaling potential trend reversals, and complementing trend-following indicators. The Relative Strength Index, or RSI, is one of the most popular momentum oscillators. It compares the average gain to the average loss over a specific period, typically 14 days, using the formula shown here. RSI oscillates between 0 and 100, with readings above 70 generally considered overbought and below 30 considered oversold. Traders use RSI to generate potential trading signals. When RSI moves above 70, it suggests an overbought condition and a possible sell signal. Conversely, readings below 30 indicate oversold conditions and potential buying opportunities. The stochastic oscillator compares a stock's closing price to its price range over a specific time period. It consists of two lines, cent K, the main line showing the current value, and cent D, which is a 3-day moving average of cent K and acts as a signal line. Like RSI, the stochastic oscillator ranges from 0 to 100 but uses slightly different overbought and oversold thresholds. Above 80 is considered overbought, while below 20 is oversold. The white line represents cent K, which responds faster to price changes, while the gold line is cent D, which moves more smoothly and provides signal confirmations. Traders watch for crossovers between the cent K and D lines. When cent K crosses above D, it generates a bullish signal, especially in oversold territory. Conversely, when K crosses below D, it suggests a potential bearish move. The moving average convergence divergence, or MACD, combines trend following and momentum elements to identify potential entry and exit points. MACD consists of three components: the max D line, which is the difference between 12 and 26 period EMAs, the signal line, a 9-period EMA of the MACD line, and the histogram, which visualizes the difference between the MACD and signal lines. Unlike RSI and stochastic, MACD doesn't have upper and lower boundaries. Instead, it oscillates above and below a zero line. The MACD line in green tends to move faster, while the red signal line follows more slowly, creating trading signals when they cross. The histogram represents the difference between these two lines, highlighting momentum changes with its height and color. Traders look for several signals with MACD. When the MACD line crosses above the signal line, it suggests bullish momentum. When it crosses below, it indicates bearish momentum. The histogram changing direction often provides early warning of potential trend changes, while MACD crossing the zero line confirms a shift in the underlying trend. Divergence occurs when the price of an asset and an oscillator move in opposite directions, signaling a potential trend reversal. In this example, we can see bearish divergence. The price makes a higher high, but the RSI makes a lower high, indicating weakening momentum despite rising prices. Notice these critical points where divergence occurs. While price continues making higher highs, the RSI fails to confirm, suggesting the uptrend is losing strength and may soon reverse. There are two main types of divergence. Bearish divergence occurs when price rises while the oscillator falls, signaling potential downside. Bullish divergence happens when price falls while the oscillator rises, suggesting a possible upward reversal. When applying oscillators in real trading, remember these practical tips. Oscillators work best in range-bound markets and can give false signals during strong trends. For best results, combine multiple oscillators for confirmation, use them alongside trend-following indicators, and always consider the broader market context. Here's a quick comparison of the oscillators we've covered. RSI and stochastic both range from 0 to 100 and excel at identifying overbought and oversold conditions. MACD has no upper or lower limits and is particularly useful for identifying trend changes and momentum shifts. Volume analysis is a critical component of technical analysis that can confirm price trends and provide early warning signals. Volume represents the number of shares or contracts traded during a specified time period. It indicates the strength and conviction behind price movements. The key to volume analysis is understanding how it confirms or contradicts price action. Let's look at a typical price chart with volume. When price increases are accompanied by increasing volume, it confirms the bullish trend. This shows strong buying pressure and conviction. Volume spikes often occur at key support and resistance levels. These indicate strong buying at support or strong selling at resistance. Volume patterns at market tops often show diminishing buying interest as prices make new highs. This divergence is a warning sign. At market bottoms, we often see volume spikes as sellers capitulate. This shows selling exhaustion and potential reversal. Volume often acts as a leading indicator, changing before price does. This can provide early warning signals of potential trend changes. Notice how volume increases before the price movement occurs and decreases before price begins to fall. This pattern often provides early warning of trend reversals. To summarize, volume analysis helps confirm trends, identify key support and resistance levels, spot market tops and bottoms, and can provide early signals of trend changes. In this final section, we'll cover practical applications of pattern recognition and essential risk management techniques. Successful traders combine multiple pattern recognition techniques to increase signal reliability. Technical patterns such as support and resistance lines provide the foundation. Adding volume analysis offers confirmation of pattern strength and potential breakouts. When multiple techniques align, the probability of a successful trade increases significantly. Confirmation is essential before acting on any pattern recognition signal. When all indicators align with high volume and consistent timeframes, you have a strong trading signal. Conflicting signals or low volume confirmation should reduce position size or lead to avoiding the trade entirely. Successful traders develop a methodical approach to confirmation, checking multiple factors before committing capital. Effective risk management is essential for long-term trading success. Always determine your entry point, profit target, and stop-loss level before entering any trade. Calculate your risk-reward ratio by measuring the distance to your stop-loss versus your profit target. Position sizing is critical. Most professional traders risk only 1 to 2% of their capital on any single trade. Place stop losses at logical price levels below support for long positions or above resistance for shorts. Aim for a minimum risk-reward ratio of 1 to 2, meaning your potential profit should be at least twice your risk. Developing a systematic approach to trading transforms pattern recognition from art to science. Start by identifying potential patterns in your chosen market. Confirm these patterns with technical indicators such as moving averages or oscillators. Check volume to ensure sufficient market participation validates the pattern. At the decision point, determine if all signals are aligned. If signals confirm each other, execute the trade according to your plan. If signals conflict, have the discipline to skip the trade. Emotional discipline is critical for long-term success in pattern trading. Follow your system consistently, document all trades, manage emotions during drawdowns, and focus on your process rather than individual results. As we conclude our exploration of pattern recognition and technical analysis, let's review the key takeaways. First, combine multiple pattern recognition techniques to increase signal reliability. Second, always wait for confirmation across different indicators before committing capital. Third, implement strict risk management for every trade to protect your capital. Fourth, develop and consistently follow a systematic trading approach. Finally, maintain emotional discipline throughout your trading journey. Remember this quote from Alexander Elder: "The goal of a successful trader is to make the best trades. Money is secondary." By applying these principles consistently, you'll be well positioned to navigate markets successfully using pattern recognition.